All right, so you are welcome to the second part of IFRS 9. So we are still at IFRS 9, recognition and measurement of recognition and measurement of financial instruments. All right, and so far we have been through the financial assets, and we ended with the recognition of the financial assets. And so what we're going to do right now is to pick up an example and deal with about the financial asset, the derecognition, the factoring. All right. Then we go on in and we look at the equity instrument. Then we end up with the financial liability. So let's go and pick up a question and look at it. All right. So let's see from the past questions, is there anything that we've had on in terms of derecognition? All right. Okay. So we have this question 24, which is November 2021. So that is the question we are going to use. All right. Okay, so let's look at question 24. It says that Agile Limited has two receivables that it has factored to a factoring agency, GBB Bank, in return of immediate proceeds of less than the face value. Of course, I explained to you that you can never get the full value. You always get something less than the face value for the year ended December 2020. And it says that both receivables are due from long-standing customers, which are expected to pay in full and on time. In addition, Agile has agreed a 3-month credit period with both customers. Now, it says that the first receivable is for 400,000, and in return of assigning the receivables, Agile Limited will receive 360,000. Under the terms of the arrangement, this is the only money that Agile will receive, regardless of when and even if the customer settles the debt. That is a factoring arrangement without recourse. We learned that. So if it is a factoring arrangement without recourse for this first receivable, how do we treat it? It's as simple. How do we treat that? I said that the 360 that she has received will be what? Will be going into our cash. We have received the cash of how much? 360,000. All right. Then we do know that the credits, and right now it means that the debt belongs to the factor, and so the receivables has to be credited. The receivable of 400,000 has to be credited. So because now we don't have the receivable anymore, we sold it to the factor, we collected 360, so we don't have the receivable in our books anymore. All right, so that is the meaning. Then you see this thing is not balancing. You remember, yes, the debit is what? Administrative expense of what? 40,000. So that's all. It balances of 400,000. It's as simple as that. That's all. That's all you do. And the second one is saying that the receivable is 200,000, and in return of assigning the receivable, Agile Limited has received 140. So this one too, the same thing. You have received a cash of what? 140. But let's read further. It says that Agile has just received the 140, and at this time of the factoring, if the customer settles on account, then a further 10,000 will be paid by the factoring agency. That is an if statement. So it's a contingent asset. You will be receiving something if something happens. So we disclose that one. You see, IAS 37 is everywhere. Okay, IAS 37 is everywhere. But if the customer does not settle in accordance with agreed terms, then the receivable will be reassigned back to Ajara, who is obliged to refund the factor to the factor, the original 140,000 plus another what, 20,000. So in this case, what is going to happen? So as for the factor with recourse, what it means is that then it means that immediately you took this money, you also have a present obligation. You took the money, you also have a present obligation. So what happens? It means that our present obligation is that we owe the factor. So you credit what? Payable for that money because it is with recourse. So that is that you don't touch your receivable. Then as it stands, the 10,000 is a contingent asset. Disclosed. The 20,000 is a contingent liability. All right. Also what? To be disclosed. That's all. You are done. So ladies and gentlemen, you do this and it's a corporate reporting question that comes 5 marks. You do these simple things, then you are done. That's all. All right. So now let's go on and start treating how we deal with financial liability. Or before we even start, let's go into our equity instrument. How do we deal with equity instruments? Don't forget, we've dealt with financial assets. So equity instruments, how do we deal with equity instruments? All right, for equity instrument, what is an equity instrument? We discussed that equity instrument, what is the residual interest? So it's a contract that gives evidence of a residual interest of an asset after deducting or what? Liability. We have established that already. So what we need to do is to do the classification. Please ask for the classification for financial instrument. Anytime a financial instrument question comes, remember to do the classification. So here, classification number 1, we have fair value through what? P&L. All right, and that is the default. Normally, every equity instrument must be fair value through what? P&L. What does that mean? The meaning of this is that the initial measurement will be what? It will be measured at what? Fair value or a purchase consideration. All right, with transaction cost going where? Yes, your guess is as good as mine. Transaction cost will go to what? The P&L. All right, so that is that. That is that. All right, subsequently, what happens? So subsequently, if you have to remeasure this, so if subsequent measurement for these ones, well, you will revalue at fair value. Then gain or loss on revaluation will go to the SPL. Simple as that. Then we have what do we have here? We have fair value through what? OCI. As for fair value through OCI, you know that the initial measurement is what? Yes, your guess is as good as mine. Initial measurement is at fair value or the purchase consideration plus what? Transaction cost. Just as we learned. All right, so that is that. So subsequent measurements, all subsequent measurements are at reporting dates. All right, subsequent measurements, what do? You revalue at the fair value. All right, then any gain or loss will go to where? The OCI. Gain or loss will go to OCI. All right, but in future, you cannot recognize this thing back to the P&L anymore. So it stays in the OCI. If you are moving it from the OCI, then it is going against your retained earnings. So that is how it is going to be. So it doesn't move to the P&L. Why? Because this is equity instrument. So that is that. In future, it doesn't go to the P&L. All right, with no subsequent reclassification. To the SPL. So when you know these principles under these IFRS 9 standard, whenever you see a question is about IFRS 9, you have to express this thing in your answer booklet. All right. If it is about the equity instrument, even if you can't solve the computation, you have to state these principles, because I've told you from the first video that immediately you know the standards that are applicable, you get a mark. Yeah. So please try as much as possible to get the understanding. All right. So that is all you need to know under equity instrument. No, non-question has been examined under equity instrument, and even if it comes as simple as you have in these principles. So let's go and look at the major one, which is the last one, which is financial liability. Financial liability. How do we deal with financial liability? Of course, the classification matters. Classification of financial liability. So here too, we have the three classifications. We have the amortized cost, we have the fair value through OCI, we have the fair value through what? P&L. But most of the time here, only two suffices, most of the time. So the classification, like I said, you have what? The default is always the amortized cost concept. So, so let's say fair value through what? P&L. Fair value through P&L. So we have that. Now, if it is fair value through P&L, initial measurement, how will it be? All right, so here we have fair value through P&L or others. The standard really wasn't specific, but we all know that the others are amortized cost and what? Fair value through OCI. So it is either fair value through P&L or not fair value through P&L. So that is how the financial liability was classified in the IFRS 9 document. All right, so this is the, so initial measurement is what? At fair value with transaction cost, what? Expense. So transaction cost is what? It's expense. So that is that. That is what you have. Basically, that is what you have. But be careful. How will you know it is fair value through P&L? We have the clues. It is what? Tradable. All right. It is what? Short term. Short term. So in these things, how do you derive your fair value? The fair value of that. Now, the fair value will be derived by doing present value of the liability. All right, cash flows of the liability. All right, so that is how you derive it. That is how you derive it. All right, so measured at fair value. Then if the fair value is not given, you have to do the present value. Okay, but since these things are tradable, most of the time, they might have to give you the fair value. All right, if it is not given, then you do the present value of the cash flows. What are the cash flows? Don't forget, the cash flows are the interest and what? The principal, because those are the amounts that you owe. All right, so that is that. Then we have all the others. We have the others. And like I said, even though the standard says fair value through P&L or no fair value through P&L, the default is among the others. And the others are what? The amortized. So before this, let me even talk about the subsequent measurement quickly. So let's talk about the subsequent measurement. So what do you do? After you found the PV of the cash flows to be your liability, what do you do? Don't forget, you have to find the unwinding. All right, the unwinding finance cost. All right. Now, if you have any other closing, if it is revalued at the end at fair value, then the opening fair value versus the closing fair value, what gives you that? The difference will be going to where? The SPL. All right, so take note of that. Okay, so that is that. So now let's go to the others. All right, the others will include the amortized cost. And the amortized cost is usually the default anyway. Then we have the fair value through OCI. All right, so if the question is silent, this one is the default. All right, so that is that. So how do you do the initial measurement for a case of the default? Initial measurement. So the initial measurement, what happens is that here, you measure it at fair value. So you measure it at fair value. All right, less transaction cost. So you see, in asset, we add transaction cost. In liability, we deduct what? Transaction cost. All right, any cost incurred in. So how do you derive the fair value? So here, if it is not this one, and it is the default one, so how do you derive the fair value? You will need the nominal value or the coupon value or the face value. So coupon value or what? Face value is the same thing. You will need that. Then you will less any discount. All right, is there any discount they have to give before they can issue the liability? All right, you less the discount. And after you've less the discount, the figure you are getting is actually the fair value. It's actually the fair value. So that is what you have. Then you will less the transaction cost. All right, you less what? Transaction cost. So you less the transaction cost. Then you get your net proceeds, net cash proceeds, what you actually get from issuing the debt. All right, so that is that. Subsequently, what do? It's very easy. Since it's the amortized cost, so subsequent measurement, you do the amortized cost table. All right, so subsequent measurement. All right, so what do? We know we must bring the year, the balance brought down, which is our initial measurement. We need the finance cost unwinding, which is at the effective rate, okay, or the rate at which the entity is borrowing. You calculate it on this, so you get your, all right, then the payment. If the payment is a deduction, if it is paid, you deduct. If it is not paid, you call it what? A payable. All right, so balance carry down. And there you go. It's as simple as this. All right, so that is it. That is that. All right, so let's go and pick questions and just express these thoughts. That's all. So let's go into the past questions. All right. I think we've really dealt with so many of the past questions, and okay, I see something here. These are convertibles. We'll come back to that later. So let's go and pick some illustrations and deal with. All right, I think we have something here. Question 9, which is Hoy. There are so many illustrations, so the table that I express is what you see here. All right, so that is that. So there's a question on Hoy. That's question 9, right? Okay, I think these things have many questions inside it. So you can pick it and deal with it. So let's go and look for something past question. Then we will come and do the convertibles. All right, then we will be done. So what do we have? All these. We will look at the hedge accounting in the part 3 video. All right, so that is that. Let's see. The first question we have here, question 12, is a convertible. So we may have to skip that. We've done question 13. Question 14 and others, I think we've looked at that. Which questions do we have? This one too is a bot. I think we've looked at that. This one too is a convertible. So maybe I have to treat the convertible so that we can come back and look at this example. The listed company granted a loan. So he granted a loan. So this one too looks a financial asset. Yeah. Okay, let's look at this. Do we have a convertible in there? All right, so it says that Kaduna issued a bond, 100,000 the market price is 95. The broker charged 18,000 in relation to the issue of the bond. All right, then what happens? The bond carry a coupon of 5%, redeemable in 5 years, in 3 years' time at its face value. Kaduna wishes to account for this using the amortized cost method. However, there is a confusion about how the bond should be accounted for. Currently, the cash received is 950,000. The cash received from the issue is 900, and so the net cash received that we talked about. All right, so that is what you are currently having. So let's deal with it in this way. All right. So this is what we have. It says that currently the cash received is 950. Currently the cash received is 950,000 has been recognized as non-current liability. The broker fee is 18,000 and were deducted from the non-current liability carrying amount. The coupon is 50,000 and has been expensed at arriving at profit before interest. So what are we supposed to do? And this is also a corporate reporting. All right, so initial measurement is at amortized cost. Don't forget, it's about the added. All right, so we said we will need the nominal value. All right, so what is the nominal value? We will need the nominal value. And the nominal value is what? It said 10,000 at 100. So it means 1 million, right? So that is it, 1 million. 1 million, because it is what? 10,000 bonds at, so if the 3 zeros goes here, then it means you have 1 million. All right, there is also an issue cost. There is a brokerage fee they paid, all right? So you have to see that. Now, I told you that there has to be a discount. Don't forget that. So there has to be a discount. If there is a discount, you could see that this is the nominal. If there is a discount, you see, it looks as if they gave it at a discount of 950,000. So that's why the question is telling you the cash received from the bond is 950,000. So probably that is what they had. All right, currently that is what they have. So that is going to be your. So this is it. So that, like I said, that's going to be your cash. All right. So the cash received, this is what you are told you received. So if that is what they receive, like I told you, there is always a discount. So for something that is 100 to be at 95, what is happening? All right. So it means that the fair value, they give a discount of about 500,000, right? Yeah. So the fair value that they are receiving here is probably 950. Is that correct? All right. So they received, the fair value they received is 950. So let me see. Now 500 is actually supposed to be 50,000 because they received. So you could see clearly that the thing is the coupon is 100. They marketed it at 95. So that gives us the fair value. So the fair value is 995. So it's 95 by the 10,000, which is 950, telling you that they've actually given a discount of what? 50. So you have to be very careful. Then less the transaction cost. Less the transaction cost of how much? Broker fee of 18,000. So that is that. So now let's use this calculator. We have 950 minus 18,000. That gives us a total net proceeds of how much? 932,000. So these are initial measurements. Since they use the amortized cost concept, these are little marks in these questions. All right. These are, so balance brought down. You are supposed to do it for only 2018. It says that the broker fee has been deducted from the non-current asset. All right. So all that they are trying to tell us, you have your balance brought down of 932,000. You have finance costs, which we use the implicit rate or the effective rate. So the effective rate is given here as 7.62. So this figure multiplied by 0.0762. All right. How much do I have? I have like add 3 zeros. That gives me 71,018.4. Payments. How much have they paid so far? It has been expense. It can be expense. Please, that figure is not an expense. It's a payment. It's a cash flow payment. All right. So it can be an expense. All right. So minus 50,000 plus the 932,000. So our liability, our balance carried down should be how much? 953,018.4. All right. So this 50,000 the expense is wrong. It has to, you have to let the examiner know it's wrong. It's a cash flow payment and has to be reversed. All right. The brokerage was deducted from the non-current liabilities carrying amount. Of course, yeah. It's not the carrying amount. Yeah. You have to deduct it from this side. Yes. The fair value. All right. So that is that. All right. Then the 950 has been recognized as non-current. That is also wrong. This is what you are supposed to record as your non-current liability. All right. So basically, this that it's as simple as that. It's as if you are doing something small. If you know what you are about, this is all you do because you are meant to do this thing only for 1 year. This is all you do. You get your 5 marks. It's very, very cool, easy peasy. That's all. That's all. All right. So we need to now go and deal with the convertibles because I could see most of the past questions were about convertibles. So let's just look at the convertibles. Then we are good to go. So let's talk about convertibles. What are convertibles? All right. I keep having this for just a minute. All right. So when it comes to the convertibles, what you see in the convertible is that it has both a financial liability inside it and it has what? Equity. So you see the accounting equation that we did where at the time it had financial liability plus equity instrument. So these are convertible. So that is that. So in this case, what do you have to do? You need to know how to handle the initial measurement of the liability and that of what? The equity. All right, you need to be able to do that. Now, how do you do this in a convertible? So the initial measurement, for the liability side will be the present value of all the contractual cash flows. And what do we mean by that? The cash flows are what? The interest and what? The principal at redemption. So the principal at redemption can be at a discount, or it can also be what? At premium. So this one, how do you go about it? So this one will be the cash proceeds. The cash proceeds minus the what? The initial measurement of the financial liability. So that is what is going to get. So that is that. So initial measurement of what? The financial liability. So that is that. Now you see this one, we said the PV. So therefore, the discount factor that you are going to use is what? The rate of similar bonds without what? Convertibles. That is not convertible. So you use similar market rates of non-convertibles. Non-convertibles. All right. So ladies and gentlemen, that is it. Then you come to the subsequent measurement. Of course, the subsequent measurement for the liability, you have to do the amortized. All right. The amortized cost table. And by now, everybody knows how the amortized cost table is done, so that you can fish out the various amounts that are going to each places. Here, what do you do? Subsequently, every year, the money will be staying in the OC and it will be unchanged. All right, just that at the redemption date, you have to find out whether they are going to convert or they will not convert. And here, the question will tell you as to whether they will convert or they will not convert. And if they will convert, it means they will no longer have a liability. Everything will be what? Equity. If they will not convert, then it means that they will still have a liability existing and an equity option hanging somewhere. All right, so that is that. But if they will convert, it means change the liability. And the question will give you the ratio at which they will change the liability to have an equity. So you will use that ratio to get the entire thing into equity. All right, so basically that is that. But what we need to do is that we need to go and pick up a question and deal with it. So first, step one is to split it. How do you split? You do the present value of the cash flows. All right, what you get is a financial liability. Then you deduct it from the cash proceeds. All right, then what you get becomes the equity. And then after that, you now come and look at the subsequent measurement of doing the amortized cost table for the liability and also maintaining your equity. In the last year, if they convert, then change the status of the liability because they won't have a liability anymore. They are converting to shares. It will all be shares. All right. So that is that. So let's pick up a question and look at that. So this is a nice journey for your financial instrument. So let's look at this FR question. Let's look at this FR question. All right. So that is the question 12, right? And it is May 2016. It said that Naniama Limited issued 300 convertible bonds at par. The bonds are redeemable in 4 years' time, also at their par value of 100. The bonds pays interest annually in arrears at an interest based on the nominal of 5%. Okay, each bond can be converted to maturity into five 1 Ghana cedi shares. All right, so I told you they always give you the ratio. All right, so that is that. The prevailing market rate for a 4-year bond with no right of conversion, so without conversion, is what? 8%. So I told you that is what you use as your discount factor. And the present value of this 8% we've been given show how the accounting treatment, all right, of the initial accounting treatment, initial, not subsequent. So this question did you a favor. It's very cheap then. It's very, very cheap then. So initial, what do? We said you do what? You do the present value, right? You have to split. All right. So it means that how many years is this bond for? It's for 4 years. So year 1, what is the cash flow we are getting? It is the coupon, the interest. And we are told that the interest is what? 5%. So what are we going to do? We are going to do 5% multiplied by 3,000 convertible, which is having a value of 100. All right. And that gives us how much? That is 0.5 of 3,100, right? That is 300,000. Yeah, that is 300,000. And we are supposed to do 5% of that. So 0.05. That gives me 15,000. All right. So year 1, I have interest 15,000. Year 2, 15,000. Year 3, I'm going to get 15,000. By year 4 is the redemption, and it will be redeemed at par. So it means that I'll have the 15,000 plus my 300,000. All right. So that is that. Okay. So that gives me what? 315,000. Discount factor, yeah, rate without is 8%, and we are giving this. So sometimes the examiner can be tricky. He can also give you the discount factors of the 5%. But please, the 5% is just for the cash flow. It's not used for what? It's not used for your PVing. So please, you have to be very, very careful about that. Like I said, the examiner is always tricky. You have to be very, very, very careful about these things. So please, always make sure you understand what you are doing. So now, look at this. So this year we have 0.926, we have 0.857, 0.794, 0.735. All right, so let's do it. The last one I have 0.3735, which gives me 231,525. So the remaining I have 15,000, and I'm multiplying it by 0.794. That gives me 11,910. Then this one gives me 0.857 multiplied by 15,000. I have 12,855. Then 0.926 multiplied by 15,000. That is 13,890. So if I add everything here, what do I have? I have 13,890 plus 12,855 plus 11,910 plus 231,525. So in all, I have 270,180. What is the cash proceeds? The cash proceeds is the same as the nominal because there was no discount, no issue cost, nothing. So I will have here my cash proceed is 300,000. So the difference now is my equity. So this one is my financial liability. So my equity will be how much? So minus 300,000. That is 29,820. So that is it. So this is the initial measurement. Subsequently, I'll pick this one and do the amortized table for it. So but the question never said we should do that. So subsequently, you would have picked that one. You have 270,180. Then 8%, right? Because the finance cost, the rate is 8%. So you'd have done 0.08 multiplied by 270,180. And that gives me 21,614.4. and the payment every year was 15,000. So if I deduct 15,000 from that, and I add my 270,180, that one gives me my balance carried down is what 276,794.4. All right, so basically that is that. Okay, so that is what it would have been, and we will keep maintaining our equity. All right, so we get to the redemption date, whether we are supposed to transfer the liability into an equity or they will not convert, we will leave it as such. All right, so it's very, very easy, very, very easy. All right, we've dealt with most of these questions. Most of these questions have been dealt with. So I think when I was going through earlier, I saw most convertibles. So where are you now? Bring yourself, let's deal with you. All right, so you see this question to a FIA Limited 5,018% on July, which means the financial year should be ending somewhere in June. If not, it means that we should, yeah, it's in June. All right, so that is that. Okay. Now, this ones, they assume that the share option is taken at the end. Good. This is a typical example I want to use to show you if they will convert or if they will not convert. So this will be our last example for this lecture. All right, because it has everything that I want to do inside. All right, so it tells us that the nominal is 5 million, 18% convertible on July 2015 with interest payable annually in arrears. 3 years later, okay, on June 2018, the loan note becomes convertible into equity shares of, okay, so you see the exchange, 100,000 loan for 50 equity shares. So that is what it's going to be. All right, and it may be redeemed at par at cash at an option of the loan note holder. All right, the financial accountant has observed that the use of the convertible loan was preferential to non-convertible. All right, and that that the latter, I mean the non-convertible one, will have an interest of 24% in order to make it attractive. So that means that our market rate that we will have to be using to do our PV is what? The 24. So you see, like I told you, the examiner is tricky. He has given you this just to confuse you, and it is asking you to do how the financial statement will be in the P&L and also in the balance sheet in the respective years. So we are going to do for all the years. And it says that at the last year, which is 2018, we should assume that the share will be taken. So I'm going to do this thing in a scenario where the share will not be taken, and I'll do this thing in a scenario where the share will be taken, and that will be the end for this lecture. All right, so now look at this. What do we do? Initial measurement. It's a convertible. So initial measurement, let's try and do the split, okay? Let's try and do the split. So what is the cash flow that we are PVing? So we have, they did it in July, which means the financial year will end in what? June 2016. So we will have June 2017 and what? June 2018. All right, what are the cash flows? Cash flows come from the nominal, don't forget. So it will be 18% on 5 million. So what do we have? 0.18 multiplied by 5 million. I'm keeping 3 zeros on top, all right? Or let me just do everything. Here is 900,000. So we will pay this 900,000. Second year, we will pay the 900,000. Then the third year, you are paying the principal and the interest. So it will be 5,900,000. What is the discount factor we are using? Don't forget, with like similar ones without conversion, and this will be 24%. So we have 0.806, 0.650, then 0.524. So you see, you ask yourself, what were these things for? Useless. Part of the examiner's trick. What will be our present values? So the first one, 0.068, 806, sorry. I have 725,400. The next one, I have 900,000 multiplied by 0.650, and that gives me 585,000. The next one is 5.9 million multiplying 0.524, and what I have here is 3,091,600. So if I total this together, 585,000 plus 725,400. All right, total I'm having 4,402,000, and this is my financial liability. What is the proceed we received? The nominal, there was no discount, nothing, was what? The nominal was 5 million. So what will be the equity component? So the equity component is this minus 5 million, right? And what I have here is 598,000. So that is what I have. It is the balancing figure. All right. So now let's go and present these things. How will it be? Okay. So now we are going to do our amortization for the financial liability. So I have my year one, which my balance brought down. So let's do it well. So balance brought down. Finance cost is in arrears. So payment, then we have what? Balance carried down. So for my year one, which is 2016, what is the balance? The balance is 4,402. What is my finance cost? 24%. So 4,402 multiplied by 0.24%. That gives me a whooping 1,056,480. Yeah, that is what it gives me. Yeah, it's 24%. All right. Then the payment they make every year, we did it, I think it was 900,000. Is that not it? Yeah. It's 900,000. So 900,000. All right. So what happens then? This minus 900 plus 4,402. That gives me something around 4,558,480. All right. So that is what happens. 2017. So this will go to my SPL. This will go to my NCL. All right. So we will come back with the second year because we are supposed to do for 3 years. So 4,558,480. So that is what I have here. So that I have, I'm multiplying by 0.24. And that gives me, I'll round it, okay? So it will be 109,4,035. All right, so that is that. And there is a 900. Actually, this one there was a 0.2 there, but it's just that I've rounded it, all right? So that is that. So minus 900,000. All right, plus, so let's say 4,558,480 plus 109,4,035 minus 900,000. That is giving me 4,752,515. All right, so that is that. Then in the last year, 2018, we are told that they will convert. Now watch this. What I'm going to do is that I'm going to just do they will not convert part. So in these years, as you are recognizing this as your NCL, these things will be staying in your equity, unchanged. So now look at this. If they will not go for the equity. If they will not, that is the caveat I'm doing now, it will be this closing balance all right. Then we will do our 0.24, which would have given us 1,140,604. All right, so I've rounded it. All right, then here you'll be paying the 900,000. All right, you'll be paying the 900,000. Now, as you pay the 900,000, you also pay the 5 million. All right, sorry, you pay your liability component, because part of it is an equity. So how much liability do we have? You pay that liability of how much? 4,402,000. So it means that this side should be somewhere 0. If it is not 0, the difference should be approximation. So I can see there is like 1B out of it. So if we have this, let's say we have this. So we have 4,752,515 plus 1,140,604. All right. So that is what we will have. Now, if I less my 900,000, all right. So that is that. And I less this, the 4,402,000. I think I'll have something close to exactly. So I'm having something close to this. So that is what will happen. So our liability will be standing around this area. So this is the liability we have. If my figures are correct, normally if the figures are so correct that you don't do any approximations inside it, what is going to happen is that you should be having for the liability side, because you will have a liability at the end of the year. All right, then you also have, and if you are paying off the liability, the interest with the liability, what is going to happen is that you are going to have 0. So assuming that our liability, everything is a liability, they convert everything, there is no shares in there. So you will see that the difference that would have happened here will be your equity. So if you pay the liability, it means that you have an equity to also settle. So most of the time you will see people doing here, putting the 5 million here. So you put the 5 million here. Now, for example, if you put the 5 million here and you add these two, so let's add, you get something like 499. So these two actually gives you like 499,319. All right. So normally it should be 5 million, and all these things are become because of the computational differences that you have. All right. So that is that. So if it has been like that, let's say you less 5 million, differences should always be negligible. So because of approximations, you see you have something there. So that is what you get. That is what you get. Now, let's come back to the way the question is asking us. The question is asking us. So that is, the question is telling us that they will subscribe. They will convert everything to equity. That is what the question is telling us. All right. So what is the equity we have? We already have an equity of how much? We have an equity of 598,000. That is that. And the question said that in the year, they will convert everything into equity. So there will be no liability anymore. They will convert everything to equity. Now, if they are converting everything to equity, this is what happened. How much is the liability they had? The liability is 4,402. That is the liability they have. Now, they are going to now exchange this liability. The question said that for every 100 of the liability, they are going to get what? 50 equity shares. What is the price of the equity shares? So it says that on the basis that equity share 100 loan notes, and this is the loan note 100. of it for 50 equity shares. All right, so that is what we have. Now, if we do this, we are getting number of shares. So it tells you that they will be getting 44020 shares, okay, multiplying 50. So CD2 will cancel CD. So what is that? How much do we have? And we should be told the value of each share in the question. The value of each share. All right. So this is that we have 44020 multiplied by 50. So the number of shares is going to be 220,1000. So these are the number of shares they are going to get. Now, what is the price of every share? So normally a question should give you the price of the share at the exchange. All right. So now we are taking the price of the share in terms of the exchange to be, let's say, 1 Ghana cedi. So that is the nominal value of shares. So at par. So that is that. So equity into equity share on the basis of, but normally a question will give you the price. So assuming the price of this share is 1 Ghana cedis, then it means that at the end of the day, how much equity is the company going to have? This 598 will be there, and there will be an extra what? 2201,000 Ghana cedi plus the 598. So there will not be any liability for them at the end of the period. But if they don't, it means that they will still have a liability and they will still have an equity. All right. So that is that. So the question said that, or it may be redeemed at par in cash. So here, if you are redeeming it, this is it. You redeem everything. So the liability side is supposed to go away. So it means that they will not convert. And if they will not convert, it will be this. So this side, instead of bringing the 4402, you rather bring the 5 million because that is the bonds. And that is where we had closer to 100. All right. So that is that. That is that. All right. So ladies and gentlemen, this ends it. So in this case, the total liability, the total equity will be what? 2,798,100. All right. So in case they had to exercise it above the market value, you have a share premium. All right. By this one, we weren't giving the market value. We assume it's what? 1 Ghana cedi, and we applied it. So ladies and gentlemen, that is how it is. So thank you very much for staying.